Welcome back to the Trading Den. In today's module, we will be going over fair value gaps, the importance of them. So I don't know which module we are on, but let's get into the fair value gap module. So I am going to be going over the importance of a fair value gap, the internal range liquidity, right? We know that fair value gaps represent the internal range liquidity. External range liquidity is highs and old lows. So fair value gaps obviously represent the internal range liquidity. When we reach external and look for a retracement or a reversal, our eyes will draw to internal to become the draw. If the fair value gap, that is the internal range liquidity we are looking for, is displaced through, the external draw becomes the draw. Fair value gaps give bias. So what I mean by this statement, if it is displaced through, let's say we're in a bullish market, we just reached an old high, and now we are looking for a bullish fair value gap to become the draw. If it is displaced through to the downside, the next external draw becomes the draw. So an old low now becomes the draw, which is that external level. So let's get into the charts and show you what I mean. So we are on the NASDAQ daily chart, and right here with all of these fair value gaps, we're going to get into this because I want you to understand what you need to do whenever you have a bunch of fair value gaps like this one right here. So what you can do, this price is fractal, right? If we have a bunch of fair value gaps on the 1 minute chart or the 5 minute chart, you can do the exact same thing that I'm going to do here. So whenever we have a bunch of levels like this and we have reached external, right? We had this old high over here. So we're going to be looking for internal to become the draw, which happens to be all these fair value gaps. So what you want to do is pull out the fib and measure the range that we are in. Now, from this high to this low down here, because that is the current range we're in, we want to be looking for 50%. So right here lies 50%. Notice this fair value gap right here lies in it. We want to be looking for the fair value gap under 50%. So that would be this internal range liquidity right here. Notice this is the one that we come down into because that is fair value. This equilibrium with a fair value gap, right? ICT says fair value gaps represent fair value gap or fair value in the marketplace. So this fair value gap represents the internal range liquidity we are looking for because it lies under 50%. If we displaced through here, right? If we displaced through here, we would then use it to go lower to this external draw. That is what I mean by displaced through. But as you see, we come down here, hold this, and then we draw higher. Notice right here at this fair value gap, we close above it, we consolidate, and then we take this low right here to then take the draw higher. So we use this fair value gap as an inverse fair value gap to draw higher to the external level after hitting that fair value gap. Now, the next thing you can do with this fair value gap is go to the higher time frame. So the weekly chart, notice we have this huge fair value gap right here. Just measure out that 50%, and you want to be looking for under that 50% if we have a huge fair value gap lying somewhere. So here we are on the NASDAQ 4-hour chart. Notice right here in this piece of price action, we have a bunch of bearish fair value gaps. So if the draw is lower down here at these lows, we should respect this internal range liquidity, right? Well, the thing is, you have to wait for a lower time frame reaction, right? We're not trading the 4-hour just based off the 4-hour off of intraday price action. We're not just shorting this off the 4-hour chart to head to this low. What we want to see is a reaction on the lower time frame and a setup on the lower time frame after reaching this internal level to send us to external. Notice what we do. We displace through all of these fair value gaps, and we create 1, 2, and 3 fair value gaps. So what do you do in this situation? You pull out your fib tool, measure that 50% right here. This fair value gap is what your eyes draw to after we reach external liquidity. So we draw out that, wait for price to come down, hit this fair value gap, and then we wait for a reaction on the lower time frame, and then we target the external level. This is how important fair value gaps are. If we run fair value gaps, the next external draw becomes the liquidity we are aiming for. So in this same price action, notice right here, we have this bullish fair value gap. If we hold this bullish internal level, we expect the draw to become external and external. So we hold this fair value gap, displacement higher. We can assume that this now becomes the draw and can look for lower time frame setups to send us to this high. So here we are on the NASDAQ hourly chart. Right here we see that we have just taken this external level. So now that we have taken buy side liquidity on the hourly chart, we have this move lower, and then we have displacement higher, right? Fair value gaps represent displacement. Displacement is fair value gaps. If we have fair value gaps, that means we have displacement. And displacement in the markets is smart money tipping its hand to you, showing you it's ready to run or dump. So right here we have this bullish fair value gap. Right? This is the overnight session, right? We are not up. Well, most people are not up, or they're just not looking at the charts in this overnight session. So right here we see overnight closes below this fair value gap, right? We have displacement beneath this fair value gap right here, right? We have these fair value gaps going through this bullish fair value gap. So what becomes the draw? These lows right here. So we hit those lows, and where do we go to? We go to internal range liquidity. So let's pull out the fib. This is not a swing high, so you would pull from here to this low. Where does 50% lie? Right here in this fair value gap, right? This is not a swing high. We have a higher high on this candle right here. So this is not a swing high. So you would pull from this high to this low down here, right? This low down here is not lower than this one, so you would take it to this low. 50% lies there. So we are not looking at this fair value gap right here. We are looking at this top fair value gap. So here we are. Notice no body closures above or even inside of this, right? Okay, so we see this line right here. Go to your settings, style, and turn on this middle line. This represents 50% or CE of the fair value gap. If we have a closure above, like let's say this bearish fair value gap, if we have a closure above CE of this fair value gap, that means that this is now a weaker fair value gap, or a closure above the entire fair value gap. That is when we can expect the draw to be higher. But if we close above CE on the same exact time frame that we are looking at it on, that means it is a weaker fair value gap. But notice we completely respect it, and then we draw to this overall external level. And notice what happens when we do that. A bunch of bearish candles. So we have all these bearish fair value gaps. 1, 2. So we pull out the fib tool, measure from high to low of the range. So our eyes are on this top fair value gap, because this fair value gap is not in 50%. Yes, 50% does lie within it, but the true equilibrium would be up here in this top fair value gap. That is how I represent equilibrium of fair value gaps. Notice we get a closure above it right here. So we get a closure above it in the overnight session. So what does that mean? External now becomes the draw. Notice what happens. We go straight up to external, pull back to internal, and then we have continuation higher during New York session. And then we come back down, come back into equilibrium, and then continue, not equilibrium, back into here and sweep this low. Now this looks like displacement, right? This is probably a 4-hour fair value gap. So let's go up there. So notice this is what I said was a 4-hour fair value gap. And if we pull up the ES chart alongside the NQ, we can see ES had actually tapped into that 4-hour fair value gap. You can see my crosshairs on the right side chart. You can see that ES went into that fair value gap while NQ did not. So what does that represent? An SMT, and we will get into SMTs in a later module, but this represents an SMT on the lower time frames, and then we have continuation higher. So here we are on the NASDAQ 15-minute chart. This is 4 a.m. in the morning. Most people aren't on the charts. We will also get into New York session, but I want to show that this will also work during London session. I'm not too familiar with Asia, so I'm not going to say it. I'm guessing it works in Asia, but I am only familiar with somewhat of London and New York sessions. So we see that we just reached external here. Notice what happens. We get displacement through bullish fair value gaps with a bearish fair value gap. So right here, we can measure out this. Notice this candle does close above it, but we have no displacement through it. So this would not bother me. Notice most bodies respect this fair value gap. We consolidate in it, and then we reach that external level, which is also a higher time frame fair value gap. This is an hourly fair value gap right here. And then we have continuation higher. So we pull back into an hourly imbalance. What looks to be a reversal on the lower time frames is just a pullback retracement on the higher time frames. So we're back on the hourly chart. I want to show you how this is going to give you a daily bias, right? Right here, this bearish fair value gap, we hold to then go to external liquidity. Right? If we are bearish and want to see lower, we will displace through this external draw to then say, okay, we're probably going to be going to this low, maybe these lows down here. But notice, we get a closure above this bearish fair value gap with a bullish. So if order flow now is flipping to bullish, we will hold this fair value gap right here to get an intraday setup to send us to external liquidity. This is how fair value gaps give you bias in the market. If we close below this bullish fair value gap, this now becomes the draw. If we close above this bearish fair value gap, this becomes the draw. So if we close below bullish fair value gaps, the next low will become the draw. If we close above bearish fair value gaps, the next high becomes the draw. Sorry, I couldn't think of the word I was looking for right there. But the next high will become the draw. So this is how fair value gaps give you biases in the markets. So here we are on the NASDAQ 15-minute chart. This is yesterday's afternoon session. Notice right here we have a 15-minute fair value gap. And we come into it and then we deliver sell side liquidity. And then we get displacement higher, right? We have a fair value gap here. So it looks like order flow has now turned bullish because we are continuing to hold that, right? Well, you always need to zoom out. So let's head to the hourly chart and see what this piece of price action right here is actually doing. So right here at this red box represents that 15-minute fair value gap. Notice we have displacement on the hourly chart below bullish fair value gaps. So what does that represent? It represents external now becomes the draw on the hourly chart. So we have sell side resting right here beneath this low. Let's get rid of that box which represented this fair value gap. Notice what we do on the 15-minute chart. We held that fair value gap for what? To target internal range liquidity to then send us to that external draw. So what looks to be a flip in order flow is actually a pullback to the higher time frame internal liquidity to send us to external liquidity, right? We disrespect all these bullish fair value gaps right here. So that represents this becoming the draw now. So here we are on the NASDAQ 15-minute chart. New York session does not open until right here at this candle. This is what I mean whenever if bullish PD arrays continue to hold, that is bullish order flow, which will send us to the external draw. So what we see right here, look at all these bodies. All of these bodies continue to hold this fair value gap, right? Wicks do the damage, bodies tell the story. All of these candles throughout here continue to hold bullish in this fair value gap, and then we finally get that draw higher. So just because price wicks you out does not mean you are wrong. It just means that wicks are doing damage, and then bodies tell the story, right? ICT said it himself. Bodies tell the story, wicks do the damage. So if you get wicked out, it does not mean you are incorrect. It just means that you have gotten stop rated and then it continues. So look for a re-entry if it continues to hold. If we closed below this, yes, this now becomes the draw, which probably would have already been hit. But then we can look for these lows, these lows. Fair value gaps give you narrative in the market. If this was closed below, that means we now have bearish order flow. Notice all of these candles right here get ran through. All of these fair value gaps. What becomes the draw? These highs. Notice we take them with this wick right here. So we're going to go over a trade that I actually took in the markets, and I'll show you right here. So I said F anyone who tells you you can't do this. And then right here is that trade. So right here I short, and then right here I add. So let's get into this fair value gap and why it told a narrative. So let's head back into the charts. So right here you see this bearish fair value gap. This right here is a bearish 15-minute fair value gap. So this is where I take my first position, inside of this 15-minute fair value gap. And notice the 5-minute actually had displacement. So we mark out that fair value gap, and notice all of these bodies right here, these two candles, this candle right here, hold the fair value gap. So this is what turns into a strong inverse fair value gap. Whenever we have candles that have already previously respected the fair value gap, and then we close below it. So we hold it throughout here, and then this candle finally closes below it, representing this becoming the draw on the 5-minute chart, and then the overall draw, which was to the left on this day, becoming the overall draw whenever we close below it. So when we close below it, retest it, I take another short position to target this low on the 5-minute chart. So I take my first position off here, and then I let the runner go to the overall draw on liquidity. And then notice what happens right here. We continue to hold this fair value gap throughout here. We get a closure above it, we come down, we tap into it to use it as an inverse fair value gap, showing that this next high now becomes the draw. Notice we have no swings throughout here, right? There is no swing highs throughout here. So this high becomes the draw. Tap it, run to this external draw on the 5-minute chart. So whenever we get a closure above internal liquidity, that means that the next external high becomes the draw on that time frame. You don't want to be targeting this high on that same time frame, because that doesn't become the draw, right? This is the nice thing about external liquidity on the lower time frames. It represents internal liquidity on the higher time frames. So this high right here represents a higher time frame fair value gap. If you don't believe me, go check the charts for yourself. So we're going to look at the same price action on this same day. So right here we have this bearish fair value gap. Notice it looks like we disrespect it, right? But we're not using it as an inverse because it was never previously held as bearish. So none of these candles come up here to respect it as bearish. We get a closure above, and then what do you notice? We go straight back through it. That is why it's not highly probable, because it was not previously used as a bearish fair value gap to go lower, right? This was used to hold price, right? We hold price. This was never used to support or resist price to go lower. We go straight through it. But notice all these fair value gaps, they get closed below with these two fair value gaps. Right here we tap into this fair value gap, go straight down. That is why this is not a high probable inverse fair value gap. So here we are. We're going to go over this last example. Notice we take external liquidity on the 5-minute chart. We have this bearish fair value gap. So let's mark this out. Okay, we used it to take price to this external level. We close above it. Now this is a BPR. A BPR is whenever we have a bearish fair value gap overlapping with a bullish fair value gap. So we have two fair value gaps. So this is a BPR, right? We have a bearish fair value gap with a bullish fair value gap. This is a BPR. We have a bullish fair value gap with a bearish fair value gap BPR. BPR means a balanced price range. So whenever we have two overlapping fair value gaps, a bullish fair value gap with a bearish fair value gap, or a bearish fair value gap with a bullish fair value gap. So notice we take this external level on the 5-minute chart. We have internal right here. We close above it. We hold this bullish and this bearish. Notice bodies respect the bearish fair value gap to use it as inverse to go where? The external level. This is how fair value gaps give you narrative in the marketplace. This is how fair value gaps can give you a bias. If we close above bullish or bearish fair value gaps, the next external high on that same time frame, you have to remember it is the same time frame that the fair value gap got closed above. That same exact time frame, the external high becomes the draw. And when bullish fair value gaps get disrespected, right, this body closes below, we use it as inverse to go to the next external level on the same time frame. This is how fair value gaps give you narrative and why they are so important in the marketplace.